Okay, so this is our pictures. Richard is a former C-level executive and partner at KPMG Consulting, long experience in various industries, manufacturing, distribution, tech services, pharmaceutical, et cetera. So very experienced individual, and he's been working as an exit planner and M&A advisor for a number of years, and brings that to our presentation today. Next. Okay, so this is the firm. We're a leading full-service small business advisory firm. Our focus, as noted here, is businesses that have at least 1 million in revenue up to around 50 million. These are not hard rules. We try to make the decision on taking on clients on is the business sellable, or is there a real opportunity? If you're on the buy side, is there a real opportunity to make an acquisition? We want to make sure that we're helping people, so we don't want to take on futile efforts. And so we use that as a rough rule. We have 11 people scattered among various states. I'm in Connecticut, Richard's in Long Island, New York. As you can see, we have offices Pennsylvania, both east and west. New Jersey, Delaware, Ohio, Connecticut, where I am, New York, Tennessee, North Carolina, Texas, Florida, California. So we have they're local to the market that they're serving. They're not restricted to those states, but we find it helpful to have people where we can meet with our clients in person. We don't believe in get on a plane and parachuting in and then leaving town again after the meeting's over. That's not a very good way to build a relationship and have continuity. You'll hear one of the comments at the end about our program, our process. We try to work with business owners approximately 1,000 days before they're ready to exit, because it takes time to prepare the business and prepare the individual who's exiting, because there's a life after, and that has to be something that's also considered. So being local to our market is helpful. This is the first slide, so I'll let you go with this one, Richard. Why don't you take over?
So one of the things that we've done to really help business owners prepare is bundle a number of services that they often use in exit planning, and we've created one service called our exit value planning service. In this bundled service offering, it includes a current estimate of your business value, a value builder score report and analysis, access to all of the information in the value builder system, and we'll talk about that a little bit towards the end of the presentation. Access to our Stony Hill Academy, which is a compilation of quite a bit of information around things that owners need to know to start preparing for and to exit their business. You're provided by your advisor a written value enhancement plan on ways to improve the value of your business prior to selling. And there is ongoing active coaching and progress monitoring by your Stony Hill advisor. Also, as part of this, we're estimating what you're worth today, but we also give you a good idea, if you do these various things, how much your business value could be increased. So if we talk about exiting a business, it is really the final reward for an owner who builds a successful company. There are many complex issues, however, that need to be addressed, and these vary considerably based on each business owner's circumstances. Today, I've picked 10 critical activities that are typically involved in preparing for selling a business, and we're going to go through each of those. If you have questions, there is a chat available, I think, Paul, right? They can type
Yes.
into it. Okay. And so I'll go through each of these 10, and here's a list of the 10. We'll go through each of these, and there's certainly many, many other, but these are ones that I find are quite often very important. The first is having GAAP compliant financials. Most business owners properly focus on not paying taxes. It's a good thing, but in doing so, we end up presenting financials that show the company is making a lot less than it really is, because we're being creative in terms of how we minimize our profit and minimize our taxes. But as we start to sell a business, the business owner wants to know, well, what are you really making? How much cash flow is really being generated by your business? Quite often, there are issues of cash versus accrual accounting. A lot of smaller business, particularly, are on a cash basis, but sophisticated buyers usually want to see those financials presented on an accrual basis. Why is all this important? Well, it's because the buyer of your business, the prospective buyer of your business, can only evaluate your business if they have access to accurate and updated financials. Most buyers expect to see accrual-based accounting and generally accepted accounting practice compliant financials. That's the world in which they live, and that's how they evaluate things. So they will very likely require your financials be presented in a compliant way. So the more you do now to get your financials in order, the easier it's going to be for you to understand what the buyer is looking for and be able to communicate with them about your financials. The second item I listed is really securing an updated business valuation. How much will you net after taxes and expenses from the sale of your business? How much of those proceeds will be later taxed when you pass it on to your estate, either through estate taxes or inheritance taxes if you live in a state that has inheritance taxes? So why is it important to understand what your business is worth and what your net proceeds would be from selling your business? We think it's important to get at least a good idea, a rough idea from a market view of how much this business would likely sell for. This doesn't have to be exactly precise. It's a range of values, but it gives us a starting point in working with you to say, look, here's about what we can expect buyers to offer. Every industry has a range of values, and the real question is, how will your business fit in that range of values? Once we know this rough estimate of value, then we can start working with you, if you haven't already done so, to look at tax planning, estate planning. We can begin to calculate what your actual net proceeds will be. How much of it will go to partners, other owners, employees? How much will be consumed by taxes? We can talk with you about a number of tax mitigation strategies that would reduce taxes and increase your net proceeds. And there are expenses relating to selling a business. What are those, and how much will that be, so that you really have a good idea of how much will be available to you after the sale? The third is conducting pre-sale due diligence. We recommend this because you're going to end up having to do due diligence with the buyer anyway. So you might as well start early and get ready. Much of the value of the business, these things we talk about in terms of the multiple of the business on cash flow, a multiple of a business is inversely proportional to the amount of risk. So the more risk that you have in the business, the lower your multiple is going to be. The less risk you have in your business, the higher your multiple is going to be. So there are things that you can do to look at the risks, put together a risk management process to minimize those risks. And by doing so, you've likely increased the multiple on which your business will sell. These risks include things like loss of key customers, market risk. What's going on in the market? Is the market likely to go up or down in the next few years? Do you have contracts that have issues? Do you not have contracts where you should have contracts? Do you have any outstanding lawsuits? Do you have problematic employees, employee contracts? What if you lost 2 or 3 key employees? What would that mean to the potential buyer? Is your HR documentation clear? Do you have government? Do you have environmental risks relating to either your property or your business? And more these days, cybersecurity is becoming almost a mandatory risk management item that business owners need to be dealing with. So we suggest start now, conduct a thorough document and risk review, create a risk management plan if you don't have one, and begin now to do what I call pre-sale due diligence, so that when the time comes and you're in discussions with a real potential buyer, you're prepared. Data collection. I find it's often a big surprise to business owners about the amount of data that buyers are going to want to ask for. And what's interesting is, and it varies by prospective buyer, but I found that there's usually two types of buyers. There's the buyer who's thinking strategically, and that's often somebody high up in the buyer's organization, and they're looking for, what can we do with this company? How well will it fit with our business? They're more interested in the fit between your company and other businesses that they may have, or fit with the particular knowledge that they have in running the kind of companies that you have. Then there's almost always the analyst, and they're going to want every bit of number that you can possibly imagine. That's their job. They're going to dig down into the financials. They're going to ask for a lot of information early on in the process, like we don't give customer names out, we don't give employee names out. At the very end, that may be released to the potential buyer, but they're going to want a lot of information. So it's important that either digitally or with paper, one creates what's generally referred to as a data room. Of course, if it's digital, it's much easier for you to allow a prospective buyer to log in and view the information. But a lot of corporate documents and other things you may have in binders that haven't been digitized, although certainly one can digitize those documents. But one of the important things is very early on, start collecting this information. I don't know how many times I've worked with owners and I say, let me see your corporate docs. And they go, oh, we haven't updated those in the past 3 or 4 years, and I haven't the slightest idea where the corporate binder is. And these are important things. Buyers are going to want to see that you're a properly established corporation, that you've been maintaining corporate documents. It's just what sophisticated buyers expect. They will dig into your financials. They'll ask about what key performance indicators do you use to track your business. They'll ask for a customer list. You can certainly give them you can, customer A, customer B, customer C. You can give them customer information without revealing the exact name or contact. What kind of contracts do you have with your customers? What kind of commitments do you have from your customers to purchase on an ongoing basis? Because once again, they're looking at the future. They're looking at what the business is going to be like after they've bought it from you. HR is almost always an issue, particularly unless you have a full-time or part-time HR manager. It's likely that there's a lot of HR documents that they're going to want that you may not have easily accessible. So start that process now. I-9s, any of the HR information, recent reviews, all these things a buyer may ask for. So start now. Take while you have time and start to create some kind of data room. Legal documents. Do you have agreements with other companies? Do you have agreements with buyers? Are you in the middle of any lawsuits that you need to disclose that information on? And there may be a lot of government-related documents in terms of environmental. Maybe you're getting government grants. All these things are information that the buyer is going to want to know and that you're going to want to have readily available. And it's interesting, if you come prepared, this presents your company in a very different light. You say, well, no, I can get that for you. If they say, yeah, I'd like to see, your HR records, I'd like to see this, and this, and that. I'd like to see a file on every employee. And you go, okay, go to our data room. It's on folder XYZ. They go, wow, this is a well-managed company. This is a company that after I buy them, I'm not going to have to worry about all this stuff because they've already figured out. They know what they're doing. They have a good management team in place. They have these processes in place. So and processes and procedures. If you don't have written processes and procedures, you should, but the fact that you have them and you can readily show them to potential buyers, that's very important. So, start a process now, gather these documents, whether in a digital way or in some area in a file cabinet in your company, It's going to be much easier when you get into real negotiations with companies. I worked a bit in the aerospace industry where there's a lot of certifications you go through and a lot of processes and documents that you have to have that clearly define exactly how you do everything. Given your industry, you may not have to do that, but the more you have, the better off you are. Reduction of owner dependency. We'll talk a little bit later about the value builder system, and they've done a lot of research about factors that impact the value of a business. Owner dependency has been proven over and over again to be one of the major factors that impact the sale multiple. The more the business is dependent upon you, the less it's worth. It's that simple. So there's a lot of questions, a lot of factors involved. So, how dependent is the business on you? Do you know your customers by name? And are you the only person that knows that customer by name? How much of your business processes are dependent upon you? You can't process a major deal without you being involved. Are you a key factor with certain suppliers, that you're the one that has the relationship with these suppliers? And if you were gone, they might not be as loyal to the company. What kind of processes that you're involved in? A lot of times owners just make decisions and business moves forward. Well, how do you document that? How do you pass that on to the management team or to maybe a new manager who will come in paid for by the buyer? How do you get all that on paper? At the bottom here, I mentioned a video recording. I've seen there's some new tools out in the market that are really nice where you can very easily just sit down and record a lot of this stuff sitting in front of a computer so that you can pass on some of your decision processes for both your management team and the new buyer. Can you start now transferring key relationships to your management team? If you have key customer or key supplier relationships, introduce others in the company, introduce others in the management team, and start to have them take over that relationship so that when you leave the company, there's less likely to be some kind of negative impact. A lot of times the owner is key in marketing and key in the sales process. They're the closer. Quite often they're the one that built the business. That needs to be documented, and the process needs to be developed that's not dependent upon you. So once again, this is probably the biggest factor in terms of multiples for small businesses. Create a formal written plan. I call it an owner dependency reduction plan. This has to be thought out. It has to be written, has to be managed. It has to be, you have to have somebody responsible for this. This is a lot of work, but it could be a substantial increase in the value of your business. Six, create your story. The buyer of the company, as I said before briefly, only cares about the future of the business. That it's wonderful that you built a great business. It's wonderful that you did all the things you have in the past, but they care about what the business is going to do going forward. So they need to understand your value proposition, and they need to understand your growth story. Now, a lot of times businesses come with really ideas that, if we could go do this, but we can't afford to invest in that. Well, don't throw those ideas away. Keep those ideas on a list. And when you talk to potential buyers, go, we have a lot of opportunities to grow this company, but because we were capital limited, we were unable to go down these paths. And explain to them, we think if you do X, Y, Z, then it could grow the company by 10, 20%. So why will the company continue to grow? That's the story that you're telling. What new opportunities available to generate growth? Do you have new products in works? Do you have new products that could be added? Could you readily expand into new territories? Do you have a marketing and sales process that effectively brings on new customers? These are all things that you need to build into your story that you share with the potential buyer. How distinctive is your company from the competition? I usually recommend that my clients do in-depth competitive analysis and say, okay, these are our competitors. Here's our strengths and weaknesses. Here's their strengths and weaknesses as much as we know about them, and how you are different from your competitors. Do you have any kind of monopoly control? Do you have areas in which you clearly are the preferred source? Do you have things that only your company provides in your marketplace? That's creating, in effect, some type of monopoly. And also, is your industry one in which someone could easily come in? Are there real barriers to entry? Document that, talk about that, saying, I know when I worked in the aerospace industry and we were working with private equity groups, that was one of the major things we had. The cost to become an aerospace company with all the government regulations and all the certifications, it's almost impossible for someone to easily come into the industry these days. Well, if that's true for your industry, document that. Tell the buyer, you're don't. There isn't a risk in terms of a bunch of people coming in and competing. So once again, telling your story is everything. Recurring revenue. This is often, I find, a sort of a misunderstood concept, but there are many, many different ways in which you can generate recurring revenue, even though it sometimes is more formal, sometimes less formal. It's still recurring. Customers come back to you, they buy again. The higher is, I'm sure the higher percent of recurring revenue will reduce the risk to the potential buyer and generate a higher sale multiple. I've listed here 6 different kinds of consumables from best to less best. A simple one is, you sell razor blades, and that's a simple consumable. That's considered a sunk money consumable because you already bought the razor blade. You have to continue to buy the razors. You may have things that people need, like shampoo and toothpaste that they regularly use. That's even a better thing to do. More and more industries have moved towards some kind of subscription base where people sign up and regularly renew. Sometimes it's voluntary, sometimes it's automatic. Obviously, if you're able to get people to sign up for automatic renewal, that's a better kind of recurring revenue than if they have to manually agree to renew their subscription. There are some things where you buy like a Bloomberg terminal, and once you bought it, you have to every year subscribe, or else the product that you bought is not usable. Very similar to the razor blade analogy. Again, we talked about the number 2, subscriptions and automatic renew, but the best one is contracts. And I suspect for most of you on this call, that's where you have a lot more recurring revenue than you may think of. That you have customers in you have customers in contracts for your products and services. I'm currently working with a managed service provider, and fortunately, half their business is signed up on an annual basis, and they do have to get them to renew at the end of every year. Or sometimes they can sell a 5-year contract. That's tricky, but the longer your contract, the more clients have signed up and in agreement, legal agreement, agree to purchase your product, better off you are. This often takes a sort of creative conversation with the business owner to say, you're doing this. How can we make that more recurring? How can we make that more automatic? There's a book out called The Automatic Customer. That's where these 6 types of revenue recurring came from. But there are some very creative ways to generate more and more recurring revenue. And once again, to repeat, the more recurring revenue you have, the higher the value of your business. Number 8, develop a targeted buyer list / definition. This is something that sometimes owners have very clear idea of who might the buyer be. Sometimes they really don't have a clear understanding. The earlier you can figure out who the potential buyer might be, the better off you are. What categories of buyers are most likely going to be interested in your business? Is your business a small business and most likely an individual is going to buy it? Is yours a business where an individual company is going to buy it? Maybe it's another company in your industry. More and more family offices are an excellent source for potential buyers. If you're not familiar with family offices have been created by large successful companies, family run, often with multiple corporations in the family office. And as initially, families tended to basically put their money in with private equity groups, but then a couple of decades ago, they started saying, well, wait a minute, why should we let all the private equity groups make the money? Why don't we, in effect, become our own private equity group? So they have people who run the family office. They have investment professionals who help the family invest in companies. And the other nice thing about family offices is they tend to be a little longer term owners. They're not often focused on flipping the business in 4 to 5 years and returning money to their investors. They're really looking for long-term growth of the family assets. So as long as the business is performing well, and as long as the business is meeting their return criteria, they tend to hold on to businesses much longer than private equity groups do. If you meet the criteria of the thousands of private equity groups are out there, then a private equity group is certainly a possibility. Each of them typically have their own criteria, have their own industry focus. Many of them say, I don't do business, I don't do deals in this industry, or I prefer industry in these industries. I prefer businesses in these industries. I want businesses this size. I want this much enterprise value or cash flow or whatever. Fortunately, most of that's available to us, so we can easily match up your particular company to see if it fits the criteria of the various private equity groups that exist here in the U.S. and abroad. More and more foreign buyers have entered in the mix. I was reading this week that now Chinese companies are now in a major way pushing to buy companies in the U.S. And then there are things called fundless sponsors. I've actually worked with a couple of these people. They're an interesting group of people. They have an expertise and they have a focus. They just don't have money. So they go around and find deals. They have people who typically support them when they find the deal. But so they find the deal and then they go out and find the money. They're different than private equity groups because private equity groups already have the money from investors and they know that they have cash available to do a deal. It's also important to understand, as you I'm sure already know, that there is really a very big difference between a financial buyer and a strategic buyer. And this category can apply to the 5 different types that I listed higher on the slide. A family office may be only financially focused, or they may be strategically focused because they're in the meatpacking business and they want to buy meatpacking businesses. Strategic buyers look for the ways in which they can combine what they already have with what you have, and in fact 1 + 1 = 3. So they're looking for that extra value. Maybe your company has a list of customers that's the kind of customers they really want to go out after from their other businesses. A lot of different strategic fits, but strategic buyers typically pay more because there's a better return than a pure financial buyer that's just looking for, I'm giving you this much money, you're generating this much cash flow. So again, early on, try to figure out who's the likely buyer, because that helps you craft the story we were talking about in the previous slides, that now you can begin to target your story towards, is it likely going to be a family office? Is it more of a strategic buyer? Is it going to be a financial buyer? That impacts how we present your story to potential buyers. Resale tax and estate planning. So often we talk with people and they come to us and they say, well, I'm ready to sell in 6 weeks or 6 months. And we go, well, if you'd only called us about a year or so ago, we could have saved you a bunch of tax. So the earlier that you think about what are the kind of estate and tax issues that you're going to be faced when you sell your business. Is your business of significant value that estate taxes are going to be involved? There are many tax minimization strategies, some fairly simple and straightforward, some with a little more risk that the IRS might take a look at. But it's our job to let you know that there are quite a few choices, and it's up to you to decide which ones you think are appropriate given your appetite for risks. Many of these aren't risky, but some of them have some risk. There are many questions that really should be asked in this area. You know, who are your plan recipients of the wealth, and what are they going to do with it? How much federal and state estate and inheritance taxes will likely have to be paid? Are there business entity changes? Sometimes an S corp and a LLC or a C corp have different tax treatments and have access to certain tax rulings. So if you do it early enough, and again, I underscore the early enough, then you may have the opportunity to shift your corporate structure so that you can take advantage of a particular section of the tax code that allows certain benefits. The qualified small business stock is, for example, is one of the examples of that. What tax minimization strategies can I implement? There are, again, a number. I'm not going to go into them today. We actually had a webinar a few months ago in which we got into some detail on this. But there are a number of strategies that one can look at well before you sell, concurrent with you sell. Some of them you have to actually have the sales contract structured so that you take advantage of a tax minimization strategy. Others that you can implement after you sell, but those typically have benefit, but not as much benefit as those that you do well in advance of selling your business. Okay, and we're down to slide 10. And the 10th is about assembling an advisor and closing team. I don't know a business advisor who doesn't have, a business owner who doesn't have somebody who advises them. It may be their brother-in-law, it may be their accountant, it may be a neighbor, it may most likely they have some kind of business lawyer, attorney that they use for doing business contracts, sales contracts. But what happens when you now say, I'm really planning on selling my company, you open up to a whole new issue, a list of issues that often the current list of advisors just don't have experience handling. The complex tax issues, has your attorney actually done multiple business transactions, and have they written deal structures and letters of intent and these kind of things. So we recommend that we sit down, we look at who you've got. We're not suggesting you throw away people that you trust and like, but we say there's probably some people that we should bring in at the right point and say, look, you probably need a tax person that you don't have. You probably need an estate planner, an estate attorney if you don't have one already. You certainly need to have a very experienced transaction attorney who's done transactions, because the issues are so complex quite often. And then there's a lot of other people that you might look to advice. You may have real estate, so we may be looking into what you're going to do with the real estate. Keep it, you sell it. If you keep it, what are you going to do with it? You may, if there's family involved, you may want to bring in a family advisor. You may want to create a family council, a family-oriented board. You may already have a coach. There are a lot of HR issues in terms of preparing the employees for the company to tell them that it's being sold, perhaps to put in place some incentives to keep employees. There's a lot of HR issues that are unique to selling a business that aren't necessarily part of the day-to-day HR stuff. So anyway, having a team and having somebody to coordinate all this. That's why we recommend you assign somebody as an exit planner, because if you end up with 6 or 7 different advisors all helping you get ready to sell your business, to do the deal, to close the deal, someone has to coordinate all that. That's not likely going to be you. It's likely going to be one person who say, look, you're the project manager, whatever you want to call the person, whatever resource they come from. They're really a project manager that makes sure that everybody involved knows what's going on. They know what the timeline is. They know what tasks are that have to be done. They make sure the tasks are done so that when you move down the path and you're ready to sell, you are really ready to sell. You may be ready to sell, but your business has to be ready to sell. So that's part of what advisors do to get everything in order and ready. Okay. So regarding these 10 steps, we picked 10. I think these are 10 important ones. There are certainly likely to be other tasks, many, many tasks that aren't in these 10 that have to be identified, planned for, and addressed. In every case, you should talk to professional advisors who have experience in both exit planning and in M&A transactions, and they can help you prepare your company and propel yourself. Quite often, the issue is the owner's end game. So so you've now sold the business. What are you going to do with those proceeds? What's your life going to look like after you exit the business? So quite often the personal side of planning is also important, and that's something that trained exit planners can help you with. The result, if you do this, is more money for you, more money for your planned beneficiaries, and hopefully a more successful life after you exit your business. Do you want to open up for questions at this point, Paul?
I'd like to hold that to the end so we make sure we have time. This is an important component of what we do that's very different than others that you may know of that are, whether you call them a business broker, M&A advisor, or investment banker. Most don't do what I'm going to talk about now. Our exit value planning service is a bundled service that is intended, as Richard just talked about, to quarterback the process. And part of the quarterbacking, part of the process is to educate. So we start off with a 90-day engagement. We charge $10,000 for it. We find it's very affordable. And at the end, you have a plan for proceeding to eventual exit. It doesn't mean you have to exit immediately. We talk all the time about 2 to 3 years, which we coined the term 1,000 days is an ideal time period to begin the process. And in our coaching, that 90-day engagement, you get an estimate of value, you get a value builder score and report. There's an assessment process. You get access to the Stony Hill Academy, which we're going to talk about in a second. You get a written value enhancement plan and a continued process of coaching and monitoring by one of our advisors, and an estimate of future value based on what we think we can generate when we go to market, whether it's, again, now or later. Yeah, go ahead. Okay. We're going to show a short video here to introduce the Stony Hill Academy.
Uh-oh. The sound's not coming through, right?
I can hear it. I don't
Okay.
know others. They can't hear it, so well, let's.
In order to do that, I put it on YouTube, but I wasn't sure whether or not that was gonna work. So we'll go on past that. Sorry about that. But that was an introductory video that introduces people to the Academy.
So what we want to do today, we want to thank everybody for joining us. We have a couple.
Whoops.
I must have advanced it myself by mistake. We have a couple things we want to make an offer to you. A choice of a 30-day membership to the.
Here we go.
Yeah. Okay. So we want to start off with 30-day kind of beginner trial, initial opportunity to understand our exit value planning process. So instead of the $10,000, we will allow 30-day free membership, and then you'll get a taste, and then you can decide if you want to proceed. It'll include access to the value builder score and report, and a meeting with one of our advisors to discuss how to improve the value of your business. Or the other,
That's
the value builder score provides. This is an capsulization of what the value builder score and assessment provides. It obviously it measures through 9 value drivers. The 10th one is the assessment itself. These value drivers have been tested by the value builder system. We partner with them, and they've done, I think, 70,000 assessments through their process of been involved with over a number of years. And after getting these assessments, they can then look back at the businesses and see how well they perform against the various value drivers. These value drivers are proven ways to measure the quote value of a business, which relates to what the market value will be. And so this is a very helpful tool. We provided the tool to you in that 30-day period. You can, and we'll help you understand the value that it's providing. The other choice is the access to the academy. We have 100 courses, 60 videos. So there's a lot of content, and we will give you access and walk you through the things that are available to you in the academy, and we can curate an appropriate program to get you started, and then we'll go on. The idea here is to continue till you're ready to exit to the marketplace by all the preparatory work that as Richard talked through. It takes time, and it takes an effort that you can't dedicate 100% of your time to. So we want to spread it out over a couple of years to make it a reasonable process, step by step. So we'll invite you to let us know if you have any interest in either of these two suggested starting process. Next one, Richard. I guess you can't run this video either then.
Yep. Okay. That is
Good.
Yeah, this was an example of video. A lot of videos in the academy. Again, we have over 60 videos which go into detail. In this case, this was what's exit planning, what's the basis of exit planning, what's the benefit of having a strategic plan focused on your exit. So again, this is, you can see the movement, at least to see that these are nicely produced, professionally produced. This was actually done by an outside company that I used, that we built this for. And there's, again, quite a few videos that make it easier for you to self-learn and make it easy for us to educate you on those topics.
We have a video on our website too that does a similar introductory presentation. Using video helps tell the story.
Yep. Yep.
So that's the end of the presentation, us talking to you, but we welcome questions. So please add any questions in the Q&A portion of your screen, and then we'll see if we can answer.
So they're supposed to use the Q&A. Okay.
Yes. Okay.
You going to take these, Paul?
I can. I heard you say 1,000 days to plan for an exit. Is a 10-year exit target too soon to start now? Well, hey, there's an old saying, it's never too early to start planning your exit. People talk about it. The day you start your business, you should think about how you're going to exit. That way you stay on track. But we feel 1,000 days is usually enough in a well-run business to do the necessary documentation, organization, training, and then take it to market. So it does vary by businesses. We often have people say, I'm maybe an illness, maybe some other driving force is saying, I need to go to the market now. I want to see if I can find a buyer for my company. I don't have time or inclination to do the exit planning, and that is very valuable, and we'll do that. We don't try to discourage it, but we'd like to see the value increased. We feel that is important for our clients to be able to increase value.
I would,
Well,
I would suggest that, there's a book called Built to Sell, built by the gentleman who started the Value Builder system. And the entire premise of his book is that you build a company as if you were going to sell it. And that the things that you do to prepare for selling are the things that make businesses great. So, yes, you should be some of those things I talked about in due diligence and risk management and documenting procedures and all these things you should be doing now. It's going to make your company much more efficient, much more profitable, much more successful. So why not do it now as opposed to wait to 1,000 days before you exit? Plus, having some idea of what your exit strategy is sooner is important. Because if you intend to pass to your kids, that's just one thing, one series, one path you go down. If you're planning on selling to a third party, then that means you have to have a good management team in place. You have to be able to walk out and not be a owner-dependent company. Perhaps setting up an ESOP is going to be a good strategy for you. Well, often that's done a few years before you exit. So you should be talking with somebody who's experienced in this, even if you're 10 years away. It would be my thought.
Yeah, and I'll just add that we do valuations as well, market valuations, and just that alone, doing it 1,000 days in advance, gives you an idea of what you may receive when you then go to market. You can, and it gives you a target. If it's sufficient, great. If it's not, that's more reason to do exit planning because we can improve value.
Yeah, Paul, if you can, I'm going to take the one
Sure.
anonymous attendee. The question is, by utilizing your services, can you estimate the value add that is experienced by your clients? We talk about this value builder score, and one of the things that's built in the value builder score is a tool called the scenario planner. And what the value builder system has done is when you take the score, you're basically self-evaluating your company and where you are. And based on your answers, that gain some score, and you get to know what your score is compared to what others in your industry are. So you at least get to see whether you're best in class or whether you're average or below average. But then the scenario planner, based on 70,000 questionnaires that they put together, and every year they update actual transactions in the market, they have the scenario planner that says, yeah, if you could take the owner dependency score from 30% to 80%, the number 30 to 80, as you drag a bar on the scenario planner, it actually estimates how much, based on their data, they think your company would increase in value. So yes, we have an exact tool that can at least provide you an estimate based on this considerable amount of data that this company has collected. And it's just an invaluable tool to do exactly what you're talking about. If I improve my score in this area, then I can guess that my value would go up 10% or 5% or 20%, whatever the impact is.
One way to think about it, most valuations are dependent on the mean estimate of value in a bell-shaped curve. So you get a multiple based on EBITDA, and that multiple gives you an estimate of value. But not everybody is the mean. Some businesses are better run, and they are on the upper end of the bell-shaped curve. Some businesses have issues; they're on the lower end. So the idea of this slider, it gives you an idea if you were better than the average, the mean. This is how your business value goes up. So you get a business is never a single value. And that's some of the people who are valuation practitioners, unless you're doing it for a court case where you need an exact value. Most of the time, it's only an estimate of value because you don't know how it compares to others in the marketplace and whether the buyers find it a very desirable business. So we provide an estimate of value, and we tell you the things that can improve that value. There's a couple of questions about the presentation being available too. We have recorded this. We will make the recording available to all people who have registered, so you can watch this later. Hopefully, you find it meaningful for you at a later date. And then Anthony Bella, I want to comment. This is a very good question. We keep talking about exit planning, exit value planning, our term for it. we are M&A advisors. We help people sell their companies. The reason we focus on the preparation is we found so many occasions where the offers don't meet the needs of the client. And then there's an estimate in the marketplace throughout the industry of well over 50% of the business that go to market don't ever sell. We don't have that problem. We have a high experience closing and selling the business because we work to make it more valuable and more ready for the buyer, and we make it more so that the client owner can feel this is a good offer. So it's the preparation is extremely important, and that helps us become more successful as an M&A advisor, and that's how we stand out from the crowd.
I would say that, you know, Stony Hill's been around for 10 years. We've done hundreds and hundreds of transactions. So yes, the company and the partners have considerable experience and all of the complexities of getting deals to close. And quite often you get the buyer and then there's just all these issues that come up, and it has to be carefully managed. The communication has to be managed. Otherwise, at the last minute, the deal falls apart because somebody wants something they shouldn't want, or communications get messed up. So part of it is controlling the process so that both buyer and seller are happy and move forward with the deal.
Yeah. Another question: how do you recommend picking an intermediary based on the size and industry of your business? Well, in our size range, as I said earlier, between 1 million and 50 million in revenue is our target. That's where we work. And the other part of the question is it best to receive pitches from several firms picked based on their evaluation of your business? It's always good to have other people give you ideas, but it's not just, as I've repeated today many times, it's not just the person taking you to the marketplace. It's the person who is helping you get your business ready and then takes you to the marketplace. If they haven't been doing that for you along the way, again, 1,000 days in advance, if they haven't worked with you and invested that time to get the business ready, I would not even invite them to hear what they have to say, because they're not interested in your best interest. They're just trying to make it $1 by selling your business. It's not, our goal is to help you make the most value at the time you go to market. Question: are we located in the Philly region? We are, and we are located all over the country, as a matter of fact. My most recent addition to the team is in Houston, Texas, as an example, but we started in Philadelphia. You see my phone number, 267, that's a Philadelphia local phone number. So I'm in Connecticut, but Richard's in Long Island. So we have people all over the East Coast and all the way as far west as Texas. And we also have an individual in California that works for us too. Any other questions? These are very good questions.
Fred just commented, gotta love Philly. Oh, Fred.
He's my guy in Philly.
I think Fred's putting a plug in. Okay, if you're in Philly, call me.
Yes. Yeah, Fred, put your phone number there. And anyone else?
You can find Fred's contact number on the website.
Yes, definitely. By the way, this is a good point. Each of our advisors has certain vertical experiences from their careers, their long careers. Everybody is an experienced individual. And so as I described at the beginning with Richard, he has experience in certain industries. They've drawn upon that industry. So sometimes it's not the geographic location, it might be the industry expertise. So we use a combination of where are you located and what industry you're in terms of matching the right advisor to the task. Well, we're told 12:54, almost 1 o'clock.
One more question. Yep.
Oh.
Good question. Yep. Oh, it just popped in.
Oh, okay.
What is the total fee I should expect as a % of the sale of the business?
Do you want me to answer? That's.
You can answer it.
Sure. Our engagement fee is a percentage of the transaction value. We use a double Lehman formula. It's very standard in our industry. It's 10% of the first million of transaction value, 8% of the second million, 6 on the third million, 4 on the fourth million, and then 2% thereafter. And it's homogenized. So for instance, the simplest way to describe it is if we sell a business for $3 million, the average commission is 10% of the first million. No, I'm not even doing this right. 10% of the first million and 8% of the second million. If it's a $2 million transaction, it's 9% average. So that's one way to calculate. And so it's declining scales, because if we're selling a transaction that's $50 million, we're not going to get 10% of a whole $50 million. We know that. But then if it's $1 million transaction, that's reasonable, because the effort is just the same as it would be typically in a $50 million transaction.
I tend to answer it this way. You pay 6% to sell your house, which often doesn't take a lot of work. If you're a decent sized company, you'll probably pay about 6%. If you're a smaller company, you're going to pay more than 6%. And if you're a bigger company, you are likely to be down in the 3 and 4%, much less than you'd pay to sell your house. And the amount of effort that goes into market a company, find buyers, match buyers, and close the deal is far more effort than it is to sell a house. So it's very similar to what you pay to sell.
Yeah, it's a very private transaction. We can't put a sign outside your building and say, this business is for sale. So it's really a manual process.
Okay.
Well, thank you, everybody. Again, look for the video, and I appreciate your time. Have a good rest of the day.